Welcome to the Deep Dive. We're cutting through all the noise today to give you a really focused analysis, one we think you'll find pretty useful.
Yeah, today our mission is to properly dissect the Q3 2025 results for Viemed Healthcare. The ticker is VMD, and the call we're looking at was on November 6th.
And the story here is, it's really one of a big strategic shift. You have this company generating a ton of cash, diversifying like crazy, but, and this is the big but, the stock actually struggled after they announced all this. So our job is to figure out why. Why is the market so skeptical about this pivot?
Let's jump right into the headlines because they really were contradictory. On one hand, the top line, just phenomenal strength.
Absolutely phenomenal. A company record for net revenue, $71.9 million.
Right.
That's a 24% jump year over year. And it basically hit consensus estimates right on the money. So great momentum.
But the trouble, as you said, appeared on the bottom line. Adjusted diluted GAAP EPS, it came in at 9 cents.
And the expectation was closer to 10 cents, wasn't it?
It was. And that 1 cent difference, it sounds small, but that works out to be about a 10% surprise miss on earnings.
Okay, hold on. I need to understand that miss a little better.
Yeah.
Because if revenue was on target and the profitability metric we like, adjusted EBITDA, was great. Why the miss on GAAP EPS?
That's the key question.
Adjusted EBITDA was $16.1 million, right? Which is a really healthy 22.4% margin.
Right.
So what explains that gap?
Right, and that gap is where the story starts. For a company like Viemed, that difference between their adjusted numbers and the GAAP EPS, it almost always points to non-cash expenses tied to their growth.
Okay.
So in this quarter, you're talking about two big things. Higher stock-based compensation, that's a non-cash item, and increased amortization costs from their M&A.
The Lehans deal.
Exactly, the Lehans acquisition. So the market just sees that lower EPS number first, and it signals pressure, even if the underlying business, the cash engine, is absolutely roaring.
And when you say cash engine, you mean it. They generated $12.4 million in free cash flow just in the quarter.
Just in Q3, yeah.
Which brings their trailing 12 months number to $23.3 million. That is a serious sign of a healthy business.
It is. So you have record revenue, great cash flow, but the stock gets weak. And that all leads us right into the biggest story of the quarter, which is that strategic shift.
Okay, let's unpack this pivot. For years, everyone has known VMD as a ventilation company.
And vent specialist, yeah.
But the big headline now is that for the first time in over a decade, their core ventilation revenue is now less than 50% of their total. That is a huge deal.
It's transformative. It really is. It means they're not a one-trick pony anymore. They're not tied to a single product or a single set of regulations.
And think about this. Their ventilation sales are still growing by double digits. It's just that the rest of the business, the new stuff, is growing so much faster that it's completely changed the mix of the company.
That's right. They're reducing their risk, but they're also, changing their whole identity. They're consciously trying to become a multi-service home healthcare platform.
So what's the main engine behind this massive shift? Where is the growth coming from?
It's almost all coming from the hypergrowth in their sleep therapy segment. Management was very clear on the call. They are growing way faster than their peers. They're taking market share.
The numbers are pretty wild. New sleep patient starts grew an incredible 96% year over year.
Almost double.
Almost doubling the number of new patients walking in the door.
And that 96% number, it's amazing, but it also creates its own problems, which we can get to when we talk about their tech investments. But the real gold is in the recurring revenue.
The resupply population.
Exactly. Patients who need new masks, new tubing, that group grew 51% year over year.
And what I found fascinating was that the resupply group grew 33% just from last quarter, sequentially.
Yeah.
And that led to this huge operational milestone. Their resupply patient base is now bigger than their initial rental base.
That is a major inflection point. It means the business is shifting toward durable, really sticky recurring revenue. The value isn't just the first machine, it's the consumables for years and years. This proves the segment is mature. It's an annuity now.
Okay, so beyond that organic growth, they also closed a big acquisition in Q3. Let's talk about Lehans medical equipment. How did that go?
It went very well, and it was immediately impactful. Lehans was about 6% of Q3 revenue, and management kept saying how strategically accretive it was, and importantly, it got them into maternal health, specifically breast pumps.
And why is that specific diversification so critical for them right now?
It all comes down to reimbursement risk. The payer mix for maternal health is mostly commercial insurance and Medicaid.
Not Medicare.
Very little Medicare. So VMD is tapping into revenue streams that are, pretty well insulated from all the political and budget risks that come with Medicare. It's about stable growth.
So if they're killing it on revenue, integrating acquisitions, growing sleep by almost 100%.
Yeah.
Let's get back to that tension. Why the EPS miss? It all comes down to margins, right? These trade-offs.
Exactly. The pressure point is their gross margin. It compressed a bit this quarter, down to 57.5%. Historically, they're more in the 59 to 60% range.
And Wall Street hates margin compression.
Hates it. But management was very open about it. They basically argued this is a feature, not a bug, of their strategy.
Because the new businesses have lower margins.
That's right. Sleep, staffing, maternal health. They are all structurally lower gross margin businesses than their old high margin ventilation core. They're choosing to grow the whole pie faster, even if the margin on each new slice is a bit thinner.
So how do they keep their overall profitability, that EBITDA margin, stable in the low 20s if gross margins are falling?
Through SG&A leverage. They got way more efficient on their selling, general, and admin costs. That line item improved by 160 basis points versus last year.
Okay, so that efficiency is what's offsetting the lower margin product mix.
It is, and that efficiency is coming from technology. They are making these midterm investments in AI and machine learning tools.
For what, specifically?
To target the really complex parts of the business, patient intake, revenue cycle management, especially in that sleep business that's growing like a weed. With 96% patient growth, you have to automate just to keep up.
That makes a lot of sense. So sacrifice a little gross margin now for long-term scale and efficiency that keeps the whole thing profitable.
Okay.
Go, let's look forward. They narrowed their 2025 guidance.
They did. They fine-tuned full-year revenue to between 271 and 273 million and adjusted EBITDA to between 60 and 62 million. But they framed it as just having better visibility now, not as a step down.
On the regulatory side, they pointed to a pretty big tailwind for their original business.
Yes, the new National Coverage Guidelines for Home Non-Invasive Ventilation, or NIV, that should be a real structural lift for their core vent business, keeping that half of the company very stable while the other half diversifies.
Right. And all this growth needs disciplined capital allocation. It looks like they're delivering there, especially on share buybacks.
They really are. They finished their 2025 buyback program, taking about 1.7 million shares off the market for about $11.4 million. That's retiring roughly 5% of the entire float.
That's management putting its money where its mouth is.
It is. And their balance sheet is super clean. The net leverage ratio is tiny, something like 3.3x EBITDA. And they have $38 million just sitting there on their credit facilities.
So they have plenty of firepower for more M&A or more buybacks.
Exactly. They stressed that optionality a lot on the call.
And then finally, on the competitive front, it sounds like they're getting ready for a fight.
They are. They fully expect competitive bidding to come back for respiratory gear. They're prepared to participate everywhere, and their argument is that their scale and tech efficiency will give them an advantage when pricing gets tight.
Which brings us right back to where we started. Why is a company that's growing 24%, executing this huge shift and gushing cash, trading down?
Well, if you zoom out and look at the last year, VMD has massively underperformed. The stock is down something like 29%.
Wow.
Meanwhile, the broad healthcare ETF, the XLV, is actually up around 9%. So VMD is really swimming against the current.
So what's behind that discount? Why is the market punishing them?
It's a mix of things. You have the specific VMD issues like that small EPS miss and the gross margin compression. That stuff spooks the market.
Right.
But then you have the external factors. VMD is a small cap stock and a part of healthcare that's kind of out of favor. And you also have the illiquidity issue.
Explain that. How does illiquidity hurt the valuation?
Well, small cap stocks that don't trade a lot of shares every day are just less appealing to big institutions. So when any bad news hits, the selling pressure gets magnified because there just aren't enough buyers around. It creates what analysts call an illiquidity discount.
But the fundamental case from analysts is that this valuation is just crushed. They're trading at multiples way below their history. Sub 1x sales, around 4x forward EBITDA.
I mean, it screams undervalued if you believe in the plan. The strategy is sound. They want to be a tech-enabled home care consolidator. If they can keep growing and keep that free cash flow coming, the valuation gap should close eventually. The real question is, what makes the market pay attention now?
And that leads us perfectly into our final segment. Time for our outrageous but plausible pitch. And remember, this is purely for educational exploration, not financial advice.
Okay, so the thesis here is all about capital and market inefficiency. We're calling it the leverage and liquidity buyout bet.
I like it.
The pitch is to go long VMD, with the expectation that management is basically forced by this massive discount to launch an accelerated share repurchase, an ASR, in Q4 or early 2026.
And an ASR, just to be clear for everyone, that's not your typical buyback. It's much more aggressive.
Much more. With an ASR, the company uses its cash or debt to buy a huge block of stock from an investment bank all at once. The shares get retired immediately. It's a big, fast move.
So why is that so plausible for them right now?
All the data points to it. The stock is cheap. Their free cash flow is strong, over $23 million. Their leverage is almost zero. Buying back their own discounted stock is, without a doubt, the highest return on investment they can get.
And they have the $38 million in dry powder on the credit line to do it tomorrow if they wanted.
Exactly. And in a stock this illiquid, forcing that kind of supply reduction with an ASR would instantly take a huge chunk of shares out of the market. It could trigger a sharp repricing that has nothing to do with fundamentals and everything to do with supply and demand.
Forcing the valuation to finally catch up to the operational reality.
That's the idea. The fundamentals support it, and the financial structure pretty much demands it.
All right, so to recap the core story here. VMD has successfully diversified its business, its sleep segment is a rocket ship, and it's been smart with its capital through buybacks.
The strategic story is solid. They're moving from being a niche player to a broad platform. It's a calculated, deliberate shift.
Which leaves us with one final provocative thought for you to chew on. Even though they've had great success with their SG&A leverage, that persistent drag on gross margin from diversification is the key tension here. Will their investments in AI and tech be enough in 2026 to stabilize their net income margins, even as the product mix keeps shifting to those lower margin businesses?
That's the tightrope they have to walk, balancing that explosive growth with margin stability. And it's the number one thing we'll be watching next quarter.
Thank you for joining this deep dive. We'd love to hear your insights.